How are Bitcoin and other cryptocurrencies classified for tax purposes? Tax authorities tend to classify Bitcoin and other cryptocurrencies as property for tax purposes and not as currency. Our analysis will begin with looking at the U.S. Internal Revenue Service's approach to the tax classification of Bitcoin and other cryptocurrencies, followed by a review of the distinctions of the Canadian tax approach of the Canada Revenue Agency. The IRS's tax classification used in the United States was first established in IRS Notice 2014-12, and the general tax principles applicable to property transactions apply to transactions involving digital assets like Bitcoin. The key aspects of the IRS classification of Bitcoin and other cryptocurrencies includes: it is not treated as currency. Cryptocurrencies are not treated as money for purposes of determining foreign currency gain or loss. Taxable events. Any disposition of the cryptocurrency is a taxable event, similar to selling a stock or other capital asset. This includes selling a cryptocurrency for US dollars or other real currency, exchanging one cryptocurrency for another, such as Bitcoin for Ethereum, using cryptocurrency to pay for goods or services. Capital gains and capital losses. If you hold a digital asset as a capital asset for investment purposes, you will generally realize a capital gain or loss when you sell, exchange, or dispose of it. Short term. If held for 1 year or less, the gain is taxed at ordinary income tax rates. Long term. If held for more than 1 year, the gain is subject to the lower long-term capital gains rates. Ordinary income. You realize ordinary income when you receive cryptocurrency as payment for services like wages or independent contractor pay, for mining or staking activities, from a hard fork or airdrop in most cases. U.S. taxpayers are required to report all digital asset-related income and transactions on their federal income tax returns. The Canada Revenue Agency, CRA, generally takes a similar position as to Bitcoin and other cryptocurrencies being a form of capital property for income tax purposes, specifically non-depreciable capital property. The key aspects of the CRA classification of Bitcoin and other cryptocurrencies includes property, not currency. The CRA views Bitcoin and other cryptocurrencies as a commodity or property, not a government-issued currency or legal tender. Capital property. In the hands of most investors, Bitcoin and other cryptocurrencies are treated as capital property, similar to stocks or bonds. When you dispose of it by selling, trading, or using it to buy goods, any profit or loss is typically treated as a capital gain or capital loss, meaning only 50% of a capital gain is included in your taxable income. Non-depreciable. As Bitcoin and other cryptocurrencies are intangible assets that do not wear out or get used up in the traditional sense, they are considered non-depreciable. The CRA's main exception to the capital property classification is if your cryptocurrency activities are considered a business, otherwise known as an adventure or concern in the nature of trade. Factors the CRA considers include frequency of transactions, time spent on the activity, intent for acquiring the cryptocurrency, and the nature of the activities, such as professional trading versus holding an investment. If your activities are determined to be a business, then your profits are taxed as business income, and 100% of the net income is taxable, not just 50% as with a capital gain. In this scenario, the crypto would be treated as inventory rather than capital property. For further investment and financial insights, we welcome you to subscribe to our YouTube channel. as well as learning about our legal practice as it pertains to investing and financing. Thank you.